Hello everyone, and welcome back to my channel. Today we're going to dive into a smart financial strategy that many overlook: using credit card balance transfers to save money. If you're carrying a balance on a high-interest credit card, this strategy can help lower your interest costs, accelerate your debt payoff, and ultimately save you a lot of money. In this video, I'll explain what balance transfers are, how they work, step-by-step instructions to execute one, as well as best practices, common pitfalls, and expert tips. Let's get started. First, let's clarify what a balance transfer is. Simply put, a balance transfer is the process of moving existing debt from one credit card to another, usually one offering a lower or even 0% introductory annual percentage rate, APR. The goal is to consolidate your debt on a card with more favorable terms, which means you pay less in interest over time. This extra room allows more of your monthly payments to reduce your principal balance instead of being eaten up by interest. Now, let's look at how this strategy saves you money. Lower interest charges. When you transfer your balance to a card with a 0% or lower APR, you're not paying as much interest each month. Faster debt repayment with less money going toward interest. Your payments work more effectively against your debt principal, helping you pay off the balance faster. Reduced financial stress. Lower monthly interest means you might even be able to pay down your debt faster than you initially planned, giving you more flexibility in your budget. Over time, the cumulative savings can be significant, sometimes amounting to hundreds or even thousands of dollars in interest that you won't have to pay. Before you jump into a balance transfer, it's important to understand the critical elements of the offer. Introductory APR. This is the low or 0% interest rate offered for a set period, usually 6 to 18 months. Balance transfer fee. Most cards charge a fee, typically 3 to 5% of the amount transferred. For example, transferring $5,000 at a 3% fee costs $150. Promotional duration. The length of the 0% APR period is crucial. The longer it lasts, the more time you have to pay down the debt before the regular, higher APR kicks in. Post-promo APR. Once the introductory period ends, the APR reverts to a higher rate. It's vital to have a plan to pay off as much as possible before that happens. Understanding these components helps you calculate whether a balance transfer will be beneficial for your situation. Not every balance transfer offer is the same. Here are the factors you should consider when choosing the right card. Introductory APR. Look for cards offering 0% APR on balance transfers. Balance transfer fee. Compare fees across cards. A lower fee is preferable, especially if you're transferring a large balance. Duration of the promotional period. More months mean more time to pay off your debt without accruing interest. Credit limit. Ensure the new card's limit is high enough to cover the amount you want to transfer. Regular APR. Understand the rate that applies after the promo period ends. Take your time to research and compare multiple offers. Tools like comparison websites and financial blogs can be very helpful in this stage. Here's a detailed step-by-step process to execute a balance transfer. Step 1. Research and apply. Use comparison websites to find the best balance transfer cards. Check your credit score first, as most offers require good credit. Submit your application online or by phone. Step 2. Initiate the transfer. Once approved, log into your new account or call customer service to request a balance transfer. Provide details like the account numbers and the amount you wish to transfer from your old cards. Step 3. Understand and accept the fee. The transfer fee will be added to your balance on the new card. Make sure you understand how this fee factors into your overall savings. Step 4. Wait for the transfer to process. It may take several days to a few weeks for the transfer to complete. Monitor both your old and new accounts to confirm that the balance is successfully moved. Ensure that the old account's balance is reduced accordingly. Step 5. Plan your repayment strategy. Once the balance is transferred, develop a plan to pay off the balance during the promotional period. Set up automatic payments and mark the end of the 0% APR period on your calendar. Following these steps carefully will help you maximize your savings and avoid any unexpected surprises. To ensure you make the most of your balance transfer, consider these best practices. 2. Budget wisely. Incorporate your new payment plan into your monthly budget and focus on paying down the balance quickly. Set up reminders. Use calendar alerts or budgeting apps to never miss a payment. Avoid new debt. Resist the temptation to use your old card for new purchases. The goal is to lower your debt, not add to it. Track your progress. Regularly review your statements and credit reports to see how your balance is decreasing. Don't ignore the fee. Always factor in the balance transfer fee when calculating your potential savings. Don't miss a payment. Late payments can not only cancel your 0% APR promotion, but also incur penalties. Don't overspend. A balance transfer should be part of a broader strategy to reduce debt, not an opportunity to accumulate more. These practices will help ensure that you're on track to pay off your transferred balance within the promotional period. Let's look at a couple of real-life scenarios to illustrate how balance transfers can make a difference. Case study 1. Imagine you have a $5,000 balance on a credit card with a 20% APR. With minimum payments, you're mostly paying interest. You transfer that balance to a card offering 0% APR for 12 months with a 3% fee, $150. Over the 12 months, if you aggressively pay off your balance, you avoid hundreds of dollars in interest charges. This extra money can then go toward reducing your principal even faster. Case study 2. Suppose you have multiple high-interest credit cards. Consolidating these into one balance transfer card with a low introductory rate simplifies your payments, reduces overall interest, and helps you focus on paying down your debt efficiently. A simplified plan often leads to better financial discipline and faster debt reduction. These examples show that when used strategically, balance transfers can be a powerful tool in your debt reduction arsenal. Here's some extra tips and insights from financial experts. Use technology. Leverage budgeting apps like Mint or YNAB to track your spending and debt repayment progress. Consult reviews. Read customer reviews and expert opinions about the balance transfer card you're considering. Monitor your credit. Keep an eye on your credit score as you make payments. Positive progress can boost your credit over time. Stay informed. Follow reputable personal finance blogs and podcasts. Expert advice can help you refine your strategy over time. These additional tips can help you stay proactive and informed, ensuring that you get the maximum benefit from your balance transfer. While balance transfers can be extremely beneficial, there are a few common pitfalls you need to watch out for. Missing the promotional deadline. Failing to pay off enough of your balance before the promotional period ends can result in high interest charges. Ignoring the transfer fee. Sometimes the fee can outweigh the savings if you're transferring a small balance. Over-reliance on balance transfers. Using a balance transfer as a quick fix without addressing underlying spending habits can lead to repeated debt cycles. New purchases on the transferred account. Avoid using the new card for additional spending. Keep it solely for the purpose of managing your existing debt. By being aware of these pitfalls, you can adjust your strategy and avoid setbacks that might negate your savings. A dynamic summary slide with icons and bullet points recapping each main segment. On-screen text lists the following. Understand the basics. Compare offers carefully. Follow a step-by-step process. Stick to best practices. Monitor your progress. Let's quickly recap what we've covered today. What is a balance transfer? It's the process of moving your existing debt to a card with a lower interest rate. How it saves you money. Lower interest means more of your payments. Reduce your principal balance. Choosing the right card. Compare introductory APRs, fees, promotional periods, and post-promo rates. The step-by-step process. Research, apply, initiate, and monitor your balance transfer. Best practices and pitfalls. Stick to your repayment plan, avoid new debt, and be mindful of fees. Expert tips and real-life examples. Use technology, read reviews, and learn from success stories to optimize your strategy. Remember, using balance transfers strategically can significantly reduce your debt burden and help you achieve financial freedom faster. Thank you for watching this in-depth guide on how to use credit card balance transfers to save money. I hope you now feel empowered to take control of your debt and improve your financial health. If you found this video helpful, please hit the like button, subscribe to my channel, and share it with anyone who might benefit from these tips. I'd love to hear your questions, comments, or personal experiences in the comments section below. Let's learn from each other. Remember, while a balance transfer is a powerful tool, it works best when paired with responsible financial habits and a solid repayment plan. Until next time, take care, stay smart with your money, and keep working toward financial freedom.